Good morning, everyone. So today we are going to talk about volume spread analysis. I have to confess first that this is my first ever webinar going live. Of course, I've done many videos and all that, but in a video you can have a retake, you can edit, you can do a lot of things, but in a webinar there are related problems, and I request all of you to bear with me for the shortcomings because this is my first webinar. So I would also like your feedback later on so that I can improve on the content and the presentations. Of course, before we proceed, I would like to give a brief introduction about me. Of course, Rajendran did talk about me, but I would like to give a brief presentation. I mean, a brief introduction to myself. Actually, I'm a control systems engineer. I have a full-time job, and I'm a part-time trader only. I do mainly positional trades. My interest in technical analysis, of course, dates way back, even when the computers were not available. The web was not there, and then even trading was difficult those days. Like you have to call the broker. They did not have the mobile phones as well. We have to call him on the landline. To get him online is going to be difficult, and you tell him to buy something at a certain price, but you never know what price is buying. And then when you want to sell it, it is more difficult because you can never sell at the price you want. So all these difficulties were there. So I remember making a chart on a chart paper, trying to draw the moving averages. But of course, it was so difficult. It was a big challenge actually. And the passion remained for the technical analysis. So it was only when we had the internet and the softwares like Metastock, AmiBroker, everything, the technical analysis passion really took off. And I started with Metastock, but later on, due to the limitations, I had switched over to AmiBroker because I like to do my own things, to experiment various indicators. And like Rajendran mentioned, two of my indicators became quite popular, which is the K-brain, which is a clone of the brain system.
Many indicators are popular. I mean, all in a sudden that I able to recollect only two indicators, and probably the VPA one.
Yeah, okay. Later on, I came across this volume spread analysis, the trade guider stuff actually. Okay. One of my friends from Gujarat, Chandrakant Soni, who was the one who introduced me to this VP or VSA rather. Yeah. Then I started reading the Tom Williams, and then finally we started coding the ideas and in AmiBroker. And we released this first version, VPA1. By the time I had also started sharing my ideas in the TraderG forum, where the thread became an instant hit. And then I think even today the only AFL in AmiBroker for volume spread analysis is only mine. Of course, it has been now translated by many people on the MT4 and also on the Ninja Trader. Mm-hmm. So now of course we have a much more matured version called the VPA4. So now I'm going to make an assumption that all of you are new to volume spread analysis, though I'm going to stick to the basics, of course, with some examples on charts and everything. So the advanced user may not be finding it very difficult, but of course it is always good to recollect the basics and also share your insights and with us so that we can all learn together. So let me start.
Yeah, before getting into the question, I just want to ask, are you a programmer by profession? Because coding and VPA kind of stuff, it requires tremendous programming experience, right?
Yeah, but I'm not a computer professional at all. I'm a control system engineer. So whatever is learned, I learned is by myself, by cut and paste and then studying the different codes. It's all by myself only. In fact, I'm very I'm not good in coding at all. That's what I feel, that because I've been trying to make some DLL files, because I have a lot of stuff which I've seen that many of the people are copying these things. The VPA is totally even the symbols are copied by that software manufacturer, HSGI, something like that. And of course, they're given me the credit for putting it on the web, but they copied it totally. So some of the things which I have, I wanted to release to the public, but I wanted to make it DLL files, because some of them you are even commercializing this stuff which I make. And,
so I think the trade guide itself, it comes around $250 per month, if I'm not wrong.
Yeah. So it's about 3,000 if I remember. The last time I was inquiring was $3,000 per year or something like that. So that is why I wanted to make some DLL files, but I could never succeed with Visual Basic and things like that. So I consider myself as a very poor programmer, actually.
Okay. Fine, sir. We can.
So let's start with the basics, actually. The general perception that the old VSA, VPA has its origin in the works of the 19th century trader Richard Wyckoff. But the very premise on which the works of Wyckoff is based which is the manipulation of the market by smart money. It is found in a book called The Game in the Wall Street by Hoyle. It was published in the year 1898. Now, the basic premise on which Hoyle and Wyckoff's and subsequently the VPA is based is that there is a group of people with huge resources at the disposal who are manipulating the market to their benefit at the cost of the retail or amateur traders. Hoyle called these people pools, and Wyckoff called them the composite man. The current popular terminology is, of course, the smart money or the SM. Okay, so before we proceed, I will just go through what Hoyle said. That is, even before Wyckoff said, what Hoyle said in his book, The Game in the Wall Street and How to Play It. This is the book, and this is available, of course, in the net. It is by Google. It has been scanned and made available by Google. One can look for it in the net and find it. It's free, actually. So I'm just going to quote from this book. Okay. The pools direct and control the grand movements of the stock market. There are at least two campaigns each year in the street, a bull and a bear campaign. The bull campaign begins after the bear campaign has been brought to a successful close. The bull campaign begins when the prices are low, when the public are bearish. All the news at this time seems to be favoring a decline. The pools can manipulate newspapers, and as well as prices. There are wars or rumors of wars. There are foreign complications. There are high money rates and general dullness. There are numerous clouds in the financial sky. Yet if one closely notices, he will see that after these conditions have existed for some time, the prices on the stock exchange, in spite of continual bad news, do not go any lower. The prices fluctuate day by day, up and down, and over a narrow range, but for some reason, in spite of continued short selling of the chronic bears, the decline is checked. Also, there is no advance in the market, may not be for weeks, but the bull campaign has already commenced. At these times, the pool's generals are quietly and steadily mobilizing their forces. In other words, they are accumulating their stocks, locking them in their strong boxes. These men set the principles, act on the principles that the time to buy stock is when the prices are low and the time to sell is when the prices are high. The pools buy when the times are bad and sell when everything looks good. The bull campaign begins in gloom and ends in glory. It begins at the bottom and ends at the top. When the period of low prices that we have mentioned have lasted for 2 to 3 months, the pools have secured their stocks. The word is given out to commence the advance. The battle takes place. The bears are defeated. The prices advance. Then there may be a retreat to encourage more short selling. Again, an advance takes place, and this time it goes a little further. But the contest wages on, the prices going up and down, with on the whole advancing. Finally, towards the end of the campaign, after 4 or 5 months of gradual advancing prices, the advance begins to be rapid and continuous. The bears are then routed, horse, foot, and dragons. The prices are booming. The public and even the bears are madly buying. All these news indications are favorable for a continued advance. The volumes of transactions are very heavy, and right then the bull campaign ends. So now we look at what Wyckoff had to say. Wyckoff was called the smart money composite man. So he says, let's call him composite man, who in theory sits behind the scenes manipulating the stocks to the disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it. When large interests are planning a campaign in stock, they lay the foundation. That is, they accumulate or distribute quantity according to the size of their venture and anticipated profit to be derived from. This is what Wyckoff had to say. So it was clear that even Hoyle was the first to mention about the smart money manipulation. Of course, Wyckoff later on refined it, and he's given us clear guidelines how to look at these, look for the signals where the smart money or the composite man manipulates the stocks. Now, the smart money, of course, how this campaign of the bull and bear campaign is done is, it is done in 4 phases. The 4 phases are accumulation, markup, distribution, and markdown. These are the 4 phases actually. Now, most of you must have seen this particular picture, which is called the Wyckoff market cycle. With the 4 phases are mentioned: accumulation, markup, distribution, and markdown. So before we go further into these 4 cycles, let's just look at basically the 3 laws of Wyckoff. The first one is the law of demand and supply. And the second one is the law of cause and effect. And the third is the law of effort versus results, effort and results. Of course, the law of cause and effect, it is very clear, when there is a cause, there has to be an effect. So here the cause would be the accumulation of the stocks by the smart money, and the effect is for eventually the markup. But first, let's look at the law of demand and supply. We all know that there will not be any demand for something when it is available in plenty and nobody wants it. As the availability decreases and more people want it, then demand increases. When the demand increases, of course, the price will also increase. And when at the same time, when supply increases, the prices will decrease because nobody wants it, nobody is willing to pay a good price for it. So the first thing the smart money does is to find something that is available plenty and cheap. The next step is to create scarcity of the same and get the people interested in which in turn generates the demand. This is the first phase, which is the accumulation. So what is accumulation? Accumulation is a process through which the smart money acquires large quantity of the stock at the lowest possible price. Accumulation is a subtle, sophisticated, and sly process of cornering huge quantity of stock that makes the remaining three phases possible, of course. Accumulation normally takes place in congestion areas. Congestion areas are mostly sideways range-bound movements where the stock appears to have no interest to either move up or move down. The smart money ensures that stock is contained below a certain upper limit, which is the supply area. At the same time, the smart money also supports the prices above a certain lower line, which is the support area or the demand zone, as we call it now. The stock moves within the supply area and the demand zone. The congestion area is characterized by indecision. So when people are bearish or bullish about a stock, the volume always increases. But when they are totally undecided whether to be bearish or bullish, then the volume remains low because nobody wants to buy it or sell it. So the volume remains low. So the low volume is one of the most important characteristics of the congestion areas. The problem is the both accumulation, distribution, both are seen in congestion areas. So it is quite difficult to find out whether it's an accumulation or a distribution. You know, sometimes when nobody is interested in the stock, even the smart money is not interested in a particular stock. So this, even in such situations, there is a sideways movement, ranging movement, a congestion area. So we can never really name it as accumulation or distribution. So that was it, makes it much more difficult. Now, if you look at this chart, particularly which I'm on the screen, which is the chart of the CIPLA. During last year, of course, there was a markdown, and then there was an accumulation area where you can see a clear accumulation area where later on it started moving up. In fact, this is one of the charts which I had even posted in my Facebook page when it broke out. And I did make good money out of from this particular breakout from the accumulation area. Now, we will go look into more examples later on once we cover the basic stuff. The next is the markup. So once a smart money has cornered huge chunks of stock, they are ready for the next move. The idea is to jack up the prices so the smart money can fill their pockets. Typically, you will see that low are getting higher. The closes are getting nearer to the high. The prices are getting higher on lower volumes as there's very less supply. The reaction happens much higher than the support line. Now, going back to this chart, if you see initially there was within this particular range, as the accumulation is ending, you can see the lows are getting higher here, and the whole movement is much above the support line here, which is about 272. Then once the accumulation is done, the stock shoots through the resistance of the supply line with higher volume. For that matter, the stock need not exhibit the characteristic mentioned above. Suddenly it can just pop out of the congestion zone. It is better to take note of the volume at this juncture. The volume need not be very high at all when it breaks out actually. Since there is no supply, smart money have the majority of the floating stock. If the volume is moderate, then we should see it coming strong soon. Otherwise, the move will collapse. So when it actually breaks out, the volume need not be really high. But unless the volume picks up very soon, this move will collapse and the stock will go back into the trading range. We should see large swift increase in the volume in case of a genuine breakout. Actually, the stock should be closing near the top. Also, too much volume is not good. It would mean that there's a lot of supply coming in. Heavy volume with stock closing in the lower half would definitely mean that supply is coming in. Typically, an increase of 150% in volume with a close near the top would indicate a successful breakout. The breakout is just the beginning. The stock moves up in stages. Each stage would be advance at higher volumes and retracement at lower volumes. Retracement is mainly due to short-term traders booking their profits. The smart money also starts distribution during the retracement. Actually, at the top of the trend, a lot of distribution is done during the retracements. The point at which the retracement stops becomes important. There should be a normally the retracement is should be about 50% of the up move or the rally. More than that, we are going into danger territory. In simple sense terms, the stock should be making higher highs and higher lows, or higher high pivots and the higher low pivots. We will also see sideways movements during the up move, which could be congestion areas. We need to pay a lot of attention to these congestion areas. For this could be the finally the stock could end in a congestion area, which is the distribution zone, before the markdown begins. And so it is necessary to see to give attention to the volumes during retracements and congestion areas. Increasing volumes near the support lines or when it reaches the lower pivot indicate problem. So as the retracement comes down, the volume should decrease and the volume should increase during the rallies. If the dramatic increase in volume, then it is time to reevaluate the positions you're holding actually. Normally the stocks towards the end of the up move or the markdown, they make a climax run, which is the prices and the volumes explode. You will find the widespread bars and high volumes towards the end. This happens when like everybody rushes not to be left out in the race. The greenhorns or the retail traders, the novices, they rush in to be not to be left out, and also a lot of shorts are covered. So there you will find a climax move which is very bullish. Soon the rapid markdown starts, leaving the weak money holding the bag and the smart money their cash. Of course, all these are very idealistic pictures, but in reality, it is much more difficult to decipher all this. But you do get a lot of indications, a lot of signals, which we'll talk about now. Then, of course, practice makes you one perfect, and then it improves your understanding of these moves, improves as we do a lot of practice. So once the distribution is complete, the markup phase finishes, and of course there are two ways to finish the markup. One is the rapid high volume thrust buying climax. A buying climax could happen, that is the last you will find a big widespread bar on ultra high volumes, but the next bar you will find it's a down bar going down, and that will be most probably a buying climax. Or the other way the markup ends is when the congestion areas where the distribution takes place. That is when the interest in the stock fades and people are not in rushing in to buy to make the climax move. Then the congestion area ensures where slowly the distribution is done by the smart money. So next is the distribution. The distribution is the process where the smart money offloads their stocks to the weak hands at higher prices. Distribution can happen during the uptrends or in congestion zones. Like so we saw that even in the markup phases, the distribution can happen in the retracement, and when there is a high volume up bars, there could be selling by the smart money. Distribution happens in a very stealthy manner. Normally, it's very, very hard to spot. It is invisible anyway to the weak hands, that is the retail traders. Then you have, let me talk a little more about distribution. It is not very easy to spot the distribution. Many times you will not even see a congestion area. The up move may slowly deteriorate and start rapidly descending after a fall of heightened activity. That is, you will see a lot of up moves and suddenly it falls. In markup phases, after the stock has run up for some time, you will see volume diminishing and the spreads are narrowing. The angle of descent becomes lesser and lesser. Sorry. The stock trends may even flatten. This would mean that demand is drying up. The buyers are not willing to pay higher prices for the stock. Although the sellers are reluctant to offload their positions, hoping and waiting for better prices. It is here the smart money slowly start offloading the stock. Much care is to be taken. Care is taken to not make it visible. Volume is never too high. Prices are supported at certain levels, so there is no panic. Here it is important to take note of the volume price pattern and angle of descent actually. The steep ascent is also a problem. Suddenly you will see the stock dropping like a stone. It is on the top you will find many patterns, like familiar patterns. Sorry for this short break. Now, it is on the top of the markup phase you will find patterns like double tops, head and shoulders, which are familiar to most of the people, which are actually distribution patterns. So when it is not possible to maintain an uptrend, the smart money moves into a congestion or the range bound move. The congestion zone will be quite similar to the zone we discussed for the accumulation. You will see the price being supported at some support level, being contained with a resistance level. The point to take note, excuse me for a minute.
So maybe we can take an 5 minutes break and then everyone can assemble back. Will that do?
Okay, just give me a few minutes break. Let me clear my throat. I'm sorry about this.
Yeah, no, not an issue. I mean, we can
Okay.
take a 5 minutes break and we can assemble by 10:47 a.m. Yeah.
Okay.
Yes, sir.
Okay.
Thank you.
Yeah.
Hello. So we're not getting your voice. So the audio is not there. You there? Yes, sir. We can continue.
Yeah. Okay. Just a minute. Yeah, welcome back. Sorry for this short disturbance. Anyway, let's continue with our look at the volume spread analysis. Now we are talking about markdown phase, which is once the distribution is finished, then the stock has to be marked down so the game can be played again. So the smart money has disposed of most of their accumulated stock, then they can start the most dramatic move, the crashing down the prices. Suddenly, the supply overwhelms the demand. Prices start tumbling actually. The spreads dramatically widen, and there is panic all over. The investors are selling in panic. But the prices drop so rapidly that most of the investors and the greenhorns or the novice traders, they end up holding their stocks and they don't never get a chance to offload their holdings. Like the markup phase, we will see some of the rallies in the downtrend. These are more of reactions. Either the smart money themselves are trying to shore up the price for the last bit of holding, and there are day traders or value investors trying to bottom pick, and of course the novice investors are trying to average their prices. So all this contribute to these rallies. But we should note the volume during these rallies. You will find that volume is more on the down days and less on the up days. When the rallies fail, the average investors panic and start selling, and that will accelerate the fall. It may take weeks for the downtrend to reach the bottom. The end is generally indicated by stopping volume. There are absorption volumes. These are the classical indications which we can use of for our make use of in our trading. The smart money may be absorbing the stock to start the game again. So towards the bottom, when you find high volume bars with long spreads and closing at the top, these are the places where the absorption is taking place by the smart money. It's also during the markdown phase you will find the rallies like the dead cat bounce. You must be very, very familiar with this term, the dead cat bounce. But always pay attention to the volume pattern during these rallies. The markdown phase is the most depressing and the cruel part of the whole smart money game. Of course, by the end of the markdown phase, the smart money may be buying their E-class Benz while the retail trader is looking for a buyer for his rundown old car actually, but he has lost all his money. Of course, the markdown phase does offer good opportunities for us as smart investors who are adept in like short side trades. It could be dangerous, but if you are adept in the short side trades, you can easily make a lot of money. But the silver lining in the smart money when the markdown phase is that here comes the opportunity to pick up stocks at very low prices and make really profitable trades. Now let's look at some of the in real-time patterns, that Wyckoff cycles. Now this is the chart of Ambuja Cements. You can see This was again 2000, early 2016. You had an accumulation area. Then it broke out on a high volume here, and then the price could not be sustained here actually. So it came down, but again there was a markup here. You can see the distribution area, and finally the markdown. So another example is the Axis Bank. You had a markdown here in the accumulation area, then the markup. But in this you can see that there is no congestion areas in the top. Most of the distribution is done during the retracements itself, or during the markup period. Only most of this distribution is done here. And finally you have the markdown. Another example I can take is the IDBI. This was in 2014. You had a long accumulation area, because this is not one of those classical accumulation areas, but you can still see that it is range bound. Then there was a mark up, and here I will take the chart of IDBI. Now you can see that finally it all ended with a buying climax. You can see the huge ultra volume widespread bars going to the top here. This is the one, a widespread bar on ultra high volumes closing on the top, which is a classical buying climax. And of course my AFL also identifies these potential buying climaxes, because you had some similar situations before. But if you look at the next bar itself, it is negated by an effort to move up bar. So this is not, it is only a potential buying climax, but that is negated by the next bar. And you have the congestion area here, and suddenly you have a effort to move down bar, which is breaking down from the congestion area, and then you have the markdown. So these are like you can see it again and again in most of the stocks. So we need to look at these various signals to make profitable trades. Let me go back to the presentation. Many of you may have seen this. It's a very familiar schematic, or this is what they call this accumulation schematics. Very popular in the net. You can find this always. And this is the distribution schematic. Now, unfortunately, I'm not going to talk about all this now. My practical experience says that these things are very theoretical and nothing of this kind of this thing. Very rarely you can see any of these indications. So, in fact, I've gone through most of Wykoffian works, including his the training program material, everything. But I've never found Wyckoff talking about all this. I think it is the later Wykoffians who were put together. Is actually Bob Evans was the one who was talking about this jumping the Greek, ice, and last point of support and all that. But these are very difficult to decipher in real life, this thing. So, but I'm not going to talk about this, these indications. I would rather talk about the signals which are useful to us. So I'm going to talk about now let's go through different signals which are really useful for us. You know, one of the most frequently seen and most useful signal is the upthrust bar. The upthrust bar is a widespread bar. It's closing at the low. The volume is high. And it happens after a move, an uptrend, and moving into new territories.
Can we say that the recent
many times,
sorry for the interruption. Can we say the last Friday ITC is an upthrust bar? ITC.
Actually, I did not update my chart for the last Friday.
Okay.
Okay. Because I was busy preparing for this presentation, I did not update this.
Okay.
But we will look at some examples which are very clearly. Okay. So the upthrust bar is to repeat, the upthrust bar is a wide range bar with high volume and closing down. It indicates the prices were marked up during the day. And of course, I said it is also applicable in other time frames. During that particular time frame, it was marked up, and the trading activity was high, as indicated by the high volume, and the prices were dropped near the low towards the closing hours or the end of the time frame. Looking at that from the smart money perspective, what happened was that the smart money marked up the prices early in the trading hours, indicating strong bullishness. So once you see the bullishness, there are a lot of weak money trying to jump into the stock, and also the shorts which were there, they tried to cover up, they rushed to cover up. So all these people take the stock prices higher. So meanwhile, the smart money is quietly distributing their holding to the weak money. So it is all their holdings are transferred to the weak money. So in the later part of the day, the smart money suddenly drastically marks down the price. So most of these weak money which bought at higher prices, they're left holding this stock at those high prices. So in order to make it like more authentic, the upthrust normally happens after a widespread bar with high volume. So when there is a widespread bar with high volume, so there is a general mood of bullishness. So the next bar, of course, it's easy to mark it up again further. So most people will jump in thing that is moving up very fast. They don't want to be left behind. They jump in to be to be part of the game, and then they get stuck. And you find that most of the times the upthrust bar is moving into a new territory. It's not like an old territory, it's a new territory most of the times. And here the volume is an important consideration. So higher the volume, the more authentic the upthrust bar is. So what do we look for when you for an upthrust bar? What are the things we have to look for? The volume, the spread, and where it is closing, whether it is low or near the low, and what was the previous bar action, and did the bar move into a new territory, or is the stock in an uptrend? Of course, you will find some similar upthrust bar like bars in other places also, but like in a candlestick evaluation, it is very important to see the position of the bars, where the bar where the bar occurs, whether it is an uptrend, whether it's in a congestion zone, or whether it's a low. The implication differs widely on the place where it occurs. So that is very important where we are. That is the place, the location of the bar matters a lot in this analysis. So high volume upthrusts are sure indication of weakness. Higher the volume, the stronger the indication. So if it's a very high volume upthrust, but it may be even better to get out of the stock at that moment. lower the closing, the stronger the indication of weakness. Ideally, it should be in the low. The close is towards the middle. That it means the SM was not successful in marking down the prices. There was too much demand. So if it is closing in the middle, then it is not really an upthrust bar. An ideal upthrust will move into new territory. Of course, it is not necessary that it should move into new territory, but the ideal one is always into the new territory. The high will be always higher than the high of the previous bar, and the low will also be higher than the previous bar. So the upthrusts are more effective when the trend has run for a longer time. Any upthrusts happening in the early trends are not really effective. These upthrust bars like I said, I'll just repeat that. Higher the volume, more the weakness. Wider the spread, more weakness. Lower the close, more the weakness. More effective after a long uptrend. Sometimes the upthrust bar happens at lower volumes. Because I call them the pseudo upthrust bars. Not as effective as the upthrust bar, but it's still a sign of weakness. But normally these pseudo upthrust bars happen in the fringes of previously known supply areas. And because it is not into new territory, it happens in the that is the near resistance areas. These you can see the pseudo upthrust bars. And when, like I said, all the indications or the signals of the VSA need a confirmation. So the confirmation comes in the next few bars. So the down bar after an upthrust bar confirms the weakness. That is, you have an upthrust bar and the next bar is a down bar, and that will confirm that the upthrust bar. And if the down bar is a widespread bar with high volume, the confirmation is stronger that the upthrust bar, and it's the right time to get out of the stock. Next, okay. Some examples here of the upthrust bar. This is BHEL stock. Now we can clearly see. Now, first one we will see this is an upthrust. Sorry. This is an upthrust bar, of course. You can see move into a new territory here, but it did not close near the low, slightly in the middle. But the next bar is an up bar. I mean, it's not a down bar, so it did not confirm that weakness, but still there was always sideways movement. Then here you have a widespread up bar, and the next bar is clearly an upthrust bar. So this is one of the most frequent indications which will really help us. Let me go to some of the charts. You can always see this. Here, the chart of IDBA. Okay, let me see the recent ones. Let's take. Well, the recent one was the. So many times, the upset does not result in a markdown, of course, but it does indicate a lot of weakness. Here is a similar chart, which this is an upthrust bar here. Clearly, it's a widespread bar on high volume, closing near the low. And the next bar is again a high volume widespread bar, a down bar, and this definitely confirms a down bar after an upthrust bar confirms the weakness. So this is the confirmation. It is the right time to get out of the stock here. So let's go back to my presentations. Now the next indication we are going to look at is the buying climax. This most of you must have heard this term buying climax. Buying climax is an widespread up bar after a good up move closing at the top on a ultra high volume. The volume is very important here. It should be ultra high volume. Okay. And again, we need confirmation as usual. So again, I will go to the chart of IDBI where we can see here we had a high volume with a potential buying climax, but of course it's too early to be a buying climax. But of course we have the limitations of the software, so it does show us a buying climax. But the real buying climax is here it comes. You can see a very ultra high volume, widespread bar closing at the top, and that is the start of the distribution zone here, and then finally we had the markdown here. So these are the real-time examples, and you can see them quite often, and they are quite effective. Here again, we can term it as a potential buying climax, but here the smart money was not able to move it up further, so finally it ended up in a sideways movement and back to the range here. So it depends on location, but here of course it does not have much significance because it is not in the end of an uptrend, or it is not after a long up move. So the significance had to be taken with respect to the position that particular bar appears. Okay, this is the buying climax. And another, now we are looking at the different signals of weakness actually. The other one is the effort to fall bar. An effort to fall bar is a widespread bar which opens on the high and closes near the low and on high volume. It normally happens in a down move and in the start of a markdown phase or a distribution range. But again, like I said, we need a confirmation for all these signals, and the next bar, if it is can easily negate the weakness if it is an up bar closing on the high. So again, let me go through some examples here. These are the frequent signals which now this one is an effort to move down bar, effort to fall, or effort to move down bar. So here it clearly moves out of the range. Even here we had an effort to move down bar, but that was clearly negated here because the close was higher than the previous close. Obviously, this negated the effect of the effort to fall down bar. But at this place, obviously, the next bar was a down bar, closing much lower. It confirms the weakness. So if this is a clear indication that this effort to fall was very successful, and that started the markdown phase. Actually, here this is an example of the effort to fall or effort to move down bar. So like I said, the next bar can negate the weakness if it is an up bar closing high. Now the next one, which is very common, is the narrows with the no demand bar. No demand bar is a narrow spread bar closing in the lower half, and the volume is always low. It appears in an uptrend and also in congestion zone. And if it is appearing in a congestion zone, it indicates that the upside is not likely to be coming soon. Of course, here, most of this material you get in the net or even Trade Guider, they say that the volume, low volume, is an indication which is that it will be lower than the previous two bars. But in my experience, I've noticed that the volume does not have significance of the two bars principles actually. If it is a low volume, it does indicate no demand bar. It need not be like lower than the previous two. It can be even as low as the previous, not lower, but even a little higher. But the overall, on an absolute terms, it should be much lower than the average volume. Then it does indicate no demand actually. A no demand bar indicates that there is no support from the smart money. Smart money is not interested in higher prices, and they are not supporting the stock. Whatever buying and selling is going on is from weak money entering and exiting. And of course, this indicates weakness because the smart money is the one which is going to move the stock up, and they are not interested. So obviously, it is a weakness. The no demand bar does not indicate any immediate reversal, of course. It's a question, it is weakness only. It is not like the buying climax, or it is not like the upthrust bar. It does not indicate immediate reversals. But in the no demand, when you are looking at the no demand bar, always look at the background. What is the background? Is it weakness? Is it strength? Sometimes you will find a no demand bar in an uptrend. But of course, it does not indicate real weakness, because it can be driven by like the smart money staying out for that day, or so it does not. So like I said before, the position of the bar matters a lot, and the background, whether it is weakness or it is strength, that also matters. If the background does not show weakness, the no demand bar does not show weakness and does not indicate reversal also. It is only showing the lack of participation from the smart money, because very soon the smart money may come in to take the stock up further. So it would be a wait and watch situation actually. Okay, now let me go to the next one. Now we looked at some of the signals of the weakness. Now let's look at some of the indication of strength. Okay, before going into the next, the strength, there are other indications of weakness, like up bars with high volume, with narrow spread, and closing in the middle or low indicate supply is coming in or swamping over the demand. That is also a weakness actually. And these kind of narrow spread bars with high volume is normally they are seen near resistance lines, because this is where the the supply is ready to come in, and then the smart money or the demand is pushing it. So when the supply swams, the volume is high, but the stock is not able to make much headway. So that is where the spread is narrow. But again, it is always needs confirmation if the next bar can change the things. So let's come back to the indications of strength. The most common, most important one is the stopping volume. So when there is stock is going down, or when the markdown phase, towards the end, you will find widespread bars, high volume bars, but they are closing in the middle. So what does it mean actually? Now, it indicates that the smart money is absorbing all the stocks. Now it is time for accumulation for the smart money. So they start accumulating even during the downtrend. So they want to start the game all over again, and they said to stop the down slide and start accumulating. As a result, they observe the stock. That is why it is closing in the middle. Otherwise, if nobody is interested, it should be closing down near the lows. Now we are closing in the middle is an indication that or even the high is an indication that there is absorption going on. Of course, the ideal stopping volume should be the stock should close in the upper side or near the top, but you will find most of the time it is closing in the middle. So let's maybe look at some examples. Let me check where. So here you can see a stopping volume. Here some absorption is your volume is higher than the average, and looks like some absorption is going on. So the stopping volume indicates that the end of bearishness is nearing. That is, the bottom is coming soon. That is what it indicates. Now, if the next bar is again a stopping volume, the volume is much higher here, and the stock is closing in the middle. And obviously, very soon we have seen the end of the downtrend or the markdown phase here. So this is the stopping volume. The next one, the strength indication is reverse upthrust bar. It is exactly reversal of the upthrust bar. It happens at the bottom where the closes in the low at a widespread bar and closing near the top. And it is normally it marks the end of a downtrend. So this is also a very useful indication for us. Now, Next is the strength indication is the effort to rise bar. It is exactly opposite to the effort to fall. So it opens at the low and closes at the high with a widespread bar and high volume. So it normally happens after up move or during an up move, the start of a markup phase and moving out of an accumulation range. These are the places where you can see these bars, and of course it again needs confirmation. The next bar can negate the strength. So let's again see if I can look at some examples. You can see plenty of them. Now here there is a small congestion zone, and you can see there's an effort to rise, a bullish shine. So the volume is, the next one is the real a genuine effort to rise bar with very high volumes. It is starting, so this is happening during a markup phase, you can see. Okay, so here again you can see an effort to rise. Of course, here an effort to rise, but the volume is so high, so it could be a potential buying climax. So, and here again you have a effort to rise bar, but next bar was a pseudo Oppressor bar, so it is totally negated the effort to rise bar here. So it's a down bar closing after a pseudo Oppressor bar, confirms weakness, and obviously then weakness came in. You have a effort to fall bar that started the weakness. But here again there was a little attempt to shore up the prices, but finally we had the markdown here. Finding the bottom is always more difficult than finding the tops. You must have always experienced that. But most of the time, bottoms will see stopping volume, some sideways moves, multiple tests before we see a reversal trend. And most of the bottoms are always, it is, a consolidation base. You rarely see a V type of recovery, because in a V type of recovery, all the distribution is done during the markdown phase only, and I mean the accumulation is done during the markdown phase, and then you have a V type of recovery. Let's go back to our signals. Sorry about this. So this was the effort to raise bar. Next one is the test for supply. This is a very important signal, but in my experience, I've seen that it is also one of the most difficult to find out, because I can see, could see tests happening, not exactly where it should happen, but of course, with experience you can get better, but it's one of the most difficult signals to find out. In the test bar is that once the smart money accumulates enough stocks, they want to see if there is a supply present before start moving the stocks up. So they need to test for the supply. So you find these test bars, which is these are average spread bars. They are not narrow or widespread, average spread bars. They are closing near the top. So they open, of course, they can open on the top. Normally, it's better if they open the top and rapidly the prices are marked down. And then again, it recovers back to the top. But the important thing is the low volume. There are two important things, considerations here. One, the most important, it's a low volume, closing at the top, average spread, and it dips into previous areas of supply. That is very important here, where the supply, they want to test if the supply exists in the previous areas of supply. So it dips into a previous area of supply. Prices are marked down by smart money. So when if there is a supply coming, that means then it will take the stocks much lower. So it will become a widespread part, and it will always close in the low or in the bottom. So since there is no supply, it can be easily marked back again to the top, and since there is no supply, the volume remains low. So a successful test confirms that there is no supply, and that will give the green signal for the smart money to markup or start their markup process. So let me, before we go, let's look at some examples. These are tests for supply in an uptrend. So when it happens in an uptrend, it is actually, these are signs of strength, right? But there's no supply, so it can be marked up further.
So there is a question from
So
Mr.
let me
Jackie.
look if we can.
There is a question from Mr. Jackie. His question is, should the supply should be above and the demand should be below? She was asking.
I mean, I didn't get it. What do you mean by supply above?
What he's saying is the dips into the previous area of demand. I don't know. I'm not able to get the exact question. He's asking like this. I mean, supply should be above and demand should be below. Is it something like that? He's asking in that sense.
Okay. I can understand, because normally we consider supply as the resistance is above and the demand is below, right? But no. Let me try to see some example where I can answer it better. Now let's take this particular. Okay, what you I can understand his question. Like normally we say the demand is down, right? I mean the support is down. That is where the demand comes in, right? Okay. Now let us see. Like here, this is a test bar actually. Now, how to explain this is like now, like here it is a congestion zone, right? I mean, if you draw, I hope you are able to see my screen properly.
Yes, very much.
And this is a small congestion zone here. Here the stock is like you had a pseudo Oppressor bar, right? That means there's a sign of weakness. So next we want to see if there is a supply existing, right? So, but so this is here you see if there is a supply because the low volume and average spread price is closing at the top, right?
Yes.
So here there's an indication there's no supply here. So that's why they were able to mark it up again further with an effort to move bar here. So yeah, if you go by pure terminology, what he says is right. In the sense that normally we look at the demand coming from the bottom and the supply from the top, right? So no, don't confuse it with the supply zones and demand zones. It is where supply was coming and then before, so you could not move up further. So that was the definition, I think, given by the trade guider and Tom Williams, actually. That's what, like, you can see many of the things which I don't agree with them, and this is again the volume. As per their formula, it is like it should be less than previous 2 bar volumes. I don't not agree with that. The volume should be generally low, much lower than the average volume. It need not necessarily be lower than the previous. That is by my experience is that. So there are some differences. Of course, each one has concocted its own versions of VSA based on the Wyckoffean principles.
So there is a question from Mr. Agarwal. He's saying, in your experience in terms of VSA, which volume bar is most tradable, or say gives the best confirmation?
See, I've been using this actually in a wider sense, like with resistance and supports. If you go through my, let me just open. Just a minute. This is the chart of Edelweiss, which I had already posted here. Now, just a minute, let me saw. So this is approximately the congestion zone, which, right? So it was being going through a congestion mode with a shakeout here actually, right? And normally my kind of trading, I would enter. It's more of a breakout kind of trading. It is this is the right place to enter. Okay, and I entered here, and I took part of my profits here. When when the trend line break happened, I booked part of my profits, and I'm still holding the rest here. Ideally, like I'm now waiting and watching, but this was a sign which, like it's after a spot on a high volume, I should have, then it put me in caution, but I'm still holding the stock here. So this is the kind of like I use these indications for my entry and exits.
Okay.
Of course, I combine with trend line breaks, and this is the way I do. But the most effective things are like stopping volumes. I find it very useful. That's where it shows me it's time to put the stock on watch list and then look for the entry point. And caution points are of course the upthrust bars. They're mostly effective, and I have also some combined indications where like you can see this green arrow up here. I call them the sentiment indicator, which I've included in the VPA 4.
Okay.
These are very good. These are a combination of, I've combined some of the signals to see the strength and weakness. So this gives me a good indication of enter. If you look at the many charts, these are quite useful. They tell you, like for example here, the green up bar is there. So that puts me in like alert. So, and here is the real entry point for me. So another green up bar. These are combination of many signals. And again, so if you go purely by VSA, and this is the congestion zone, and you have the breakout from the congestion zone or the accumulation zone. It's a very clear accumulation zone. See, this is a clear accumulation zone for me, and this is the right time to get out. And I get the confirmation from the green arrow, and it's all sign of indication. And it would have been a very good entry point.
So always your decision will be on the close of the bar, right? So always your decision will be on the close of the end of the day.
Yeah.
Okay.
End of the day, because I'm a personal trader, and then it's at the end of the day only.
Okay. So how there is one more question from Mr. Ritesh. His question is: there are 4 types of upthrust bar. If you could elaborate more on the upthrust bar and its types, the 4 types of upthrust bar. I guess he's quite familiar with the VPA concept. It seems.
Yeah, I think it's. Maybe you can tell us what are the 4 types.
Okay, Ritesh, if you could able to put down all those 4 types of upthrust bar. So hidden pseudo bar, we said a hidden pseudo bar, and normal upthrust bar, and what are the others? Hidden upthrust bar. So hidden upthrust bar, hidden pseudo upthrust bar, normal upthrust bar, and I think its last one is the pseudo upthrust bar.
Okay. Frankly, I'm looking at only 2 types of upthrust bar. If you look at my chart here, like you have an upthrust bar here, right? There's a very clear open upthrust bar, and the confirmation comes in the next bar, so it goes down. So, and the pseudo upthrust bar. These are the 2 which I look at. But of course, I look at depending on the place where it happens, and then the volume, I decide how potent is the upthrust bar. Now, here, if you look at this bar, this did not move into a new territory, right?
Yes.
So it is not as effective as if it had moved into a new territory.
Okay.
Because the volume is much lower than the previous bar. That also gives me, like, if it is higher than the previous bar, I would definitely have jumped out of the stock at that time. And so it is, I look at the effectiveness that way actually. Looking at where it is, like whether it's a new territory or it is within the previous bar, and the previous bar, what happened in the previous bar, I look at that as well. Now, obviously, this is the wide spread up bar. Normally, the previous bar for an upthrust bar, ideal conditions, it should be a widespread up bar on higher volume. But the upthrust bar itself is much lower volume here compared to, see, this is the previous bar and the much lower volume than the previous bar. So it is not going to be very effective. And that's why it did not, like, it ended here only, it did not go down further, I would say. So these are the things I look at: the volume, the previous bar action, the next bar action. So these are the things one should look for actually. And here is it's another upthrust bar, but here, of course, it moved into a new territory. Of course, it should have been more effective. But the next bar, if you see, it is a down bar, of course, but it is not like it's a much lower volume. The down bar is at much lower volume, and it's a narrow bar, almost closing in the middle. So this effectiveness of this upthrust bar is not as much as it should be. So that's the way I read the signals here. I hope Ritesh is agreeing with me on this. Ritesh seems to be knowing about VSA, so hope it gives some more insight to Ritesh actually.
Yes, I hope so. And last question. There is one more question from Mr. Jackie. What is the time frame which is essentially played in India? Can one prefer daily time frame or an hourly? How about that? Or how about doing it on intraday basis on? Or should I adapt daily, weekly, monthly? Which one have to look out for when someone is looking for an upthrust bar? So, quite a brief question now.
These upthrust bars, I think it should be quite effective in all time frames. I think because it shows. But of course, my experience has been always more on the
Hello, sir. So I think we missed your voice.
And I do believe that the smart money moves are these are prolonged activities, not like short-term activities. So these are like campaigns running into weeks nowadays, maybe not like months like before. These could be in weeks. But if you look at the daily chart, also you can see that it's the up and down moments are like more of the Wyckofian cycle is very effective in the EOD cycles. So I believe it's more effective on UOD. I may be wrong, but because I really cannot vouch for intraday time frames. But for UOD, this is very, very effective. That's what I feel.
Okay.
Any other questions?
There is one more question from Mr. Agarwal. He's again asking, in your experience, which volume bar is the most tradable, or just gives the best confirmation? He's very much curious on that, on which is the best strategy to play with VSA, which gives most confirmation. Is it just one volume bar you look around, or maybe I'll put it in a different way. Maybe you look only the volume bar alone, or you look into the other surrounding factors as well?
I do look at in the surrounding factors as well. Definitely, it is on a single bar basis. Very, very difficult to evaluate. You have to look at where the bar happens. What is the background? Are we in accumulation? Are we moving out of accumulation? Are we in a uptrend? Or those things it has to be evaluated with the background. You cannot make a decision based on one bar only.
Yeah, I think that
it is yeah. You have to look at the overall picture. Otherwise, you may be wrong. Like.
So, do you do any top?
Now, if you, for example,
yeah, there is one more question from Shiva. Do you do any sort of top-down analysis to narrow down your focus on certain scripts? How do you prepare for in selecting the scripts?
Normally, I look at I have a small scanner, of course, which scans and give me the potential stocks. Then I start looking deeper into those, and I have a small stock list which I keep following the same thing. And on a weekly basis, I have an overall look. So many people who are following me will know which are my favorite stocks, which I follow, like Cipla, all those things. Like they know what is Sun Pharma and those. Like I have a few set of stocks which I keep following, of course.
Okay.
And I have a scanner which maybe I should share that with others so that they can also use that.
Sure, yeah. You can mail me.
I will
I can
definitely think of
circulate it
that.
to the team.
Okay.
Yeah.
I will do that.
Yeah.
Of course, one of the things then these, this what I call a sentiment indicator. It's a composite of many indications. So I have a scanner for this. So that gives me like the potential ones. But this can be wrong, but my experience, many times these are more of the time these are quite useful. So those are the stocks then I start concentrating on. Now, let me look at some examples where these are clearly. Just give me a minute. For example, now this Cipla chart. See, I have this red down arrow, and I have a green arrow. This is like gives me exactly like a good entry point, a very good exit point, right? So these I just use them for only scanning purpose. So these give me the green ones, like it gives me the stocks which could result into an up move. And this part of my VPA 4 as well. So, but I'll share the scanner with you so that you can distribute to the others.
Sure, sir. Yeah.
Okay.
Yeah.
Okay. Any other question, or shall we proceed further?
Mr. Agarwal is asking, can you look into the RCOM charts, especially on February 6th and March 9? We have very high volumes on those days. And he was also previously saying that in RCOM, there was some ultra high volume bars on RCOM on February 6th and 9th of March.
RCOM.
Yes, sir. Yeah. How do we read that? That's what his question is. Recently on February and March, there are some high volume bars. Yeah. Ultra high volume bars. That's what he says.
Yeah, these are ultra high volumes. It is an upthrust bar happened, right?
Yes.
This is on 2nd March, and you have see, one of the things I do whenever I see such a thing, I immediately look for the news.
Okay.
Okay. Many of these could be news driven.
Yes, of course, it's news driven, I believe.
Maybe this was the day. I'm not very sure. Maybe was it the day when Mukesh Ambani came out with this billing plan and for the Jio. So I do not know. Like I'm just guessing. So these could be, but it's RCOM. They are one of the ones who get affected by this Jio stuff, right?
So that Jio stuff happened
So
around
it could
September.
be.
September is one where they came up with.
September, is it? Yeah.
September, yeah. That's why it started dropping off.
September.
Yeah, that's.
Yeah, dropping off. Yes. No, when the not only when such things happen, like when I'm watching a particular stock, when there is an unwarranted move, either up or down, without any this thing, then I am on alert, because the smart money, they always know the things better before us. So the action is taken before. So when the news comes, of course, then the panic strikes, and then it's going to be a bad result. We know before it, they know before itself. And whenever I see an unwarranted move, then I get on my alert and I put it in my alert list. That's what I do.
Okay.
Because many of these could be news driven, right?
Yeah.
And smart money, of course, they know the news before us. So many incidences I have seen that they have taken action before the real news comes out, actually. So this could be some news driven. I have to check this, why this, because if you look at February for Arcom, on the 30th January, you had an effort to move up bar. It was very bullish sign, but many people would have definitely thought this is going to move up. But the next bar totally negated it, the move. And on the second, sorry, I think. I'll have to look at what is the news which prompted, like, and you have another on 8th we have on the 9th we have a very high volume bar again. Again, could be news driven. So we have to see that. Anyway, now this I'm getting my green bar here, green up arrow, so it is time to put this stock in my stock list, actually. So let me see.
What does that color indicates? Okay. The red color, green color bars, and the brown, orange color bars. What does that differentiates?
Actually, 1 minute. It is actually I had given an option for it. It is a trend based, and then there is a VPA based, which is based on different colors. So they like, or my own
templates. Okay.
Maybe this could be the most ideal one, where you have the green ones when there is an uptrend. There's a red one when there is a weakness. Okay. And the change, it could be from weakness, could be white ones. So I'd given different options which people to use.
Okay.
It is similar to my histogram, actually.
Okay. Okay.
The coloring is similar to my histogram, so you can change the colors as you want, actually.
Okay. Okay. So I think we can continue with the session. There are remaining questions there. I'll put out in the next subsequent question sections.
Okay.
Yeah.
So we continue with the presentation, or?
Yes, we continue with the presentation. Yes.
Okay. The next. The next one is the no supply bar, which is again a narrow spread bar. But it is closing in the lower half, similar to the no demand bar. It is closing in the lower half, low volume, appears near bottoms, and indicates strength. Obviously, when there's no supply, then it is a sign of strength. And indication of strength if it appears after tests. So it could be before it, when you get a no supply bar, then there could follow a test, or after a test again. If you see a no supply bar, it's a confirmation that the supply for test, test for supply was successful. But these can be also found in uptrends, and which of course indicates continuation. But again, like the demand bar, you have to look at the background, where we are, the location of the bars, etc. Okay. Now there are some other indications one has to look at. Is so we covered the major indications here. The other one is like other important indications are the high volume down bar with above average spread in an uptrend indicates weakness actually. Similarly, high volume up bar with above average spread in a downtrend indicates strength. And high volume narrow spread bars in an uptrend indicates weakness. Similarly, high volume narrow spread bars in a downtrend indicate weakness. Why it is like, let me explain a bit here. High volume down bars with above average spread in an uptrend. Obviously, in an uptrend, you always looking at up bars, but there's a down bar. Normally, it is not a problem, but if the volume is high, that means a lot of supply is there. That means it is an indication of weakness. Coming to the next one, high volume up bar in above average spread in a downtrend. Obviously, downtrend, you're always looking out for down bars. Of course, we will have up bars as well in a downtrend, but it depends on the volume. Volume is high means there is a lot of demand. That is why the up bar has had high volume. So it indicates strength. That is because the demand is coming in. The next is high volume narrow spread bars in an uptrend. Narrow spread bars happens when there is either an indecision between the bulls and bears, or the demand and supply, or if there is a tough competition or fight between the demand and supply. And high volume does indicate there's a lot of demand, lot of supply. It's either in an uptrend, it is demand absorbing the supply, but the price itself is not able to make headway. So obviously that demand is there. Demand is trying to absorb all the supply, which is good news. The supply is overwhelming the demand, so it is a sign of weakness. Similarly, high volume spread bars in downtrend. Again, it is the tussle between the demand and supply, which makes the spread narrow, and the high volume indicates a lot of supply and a lot of demand. So the supply is trying to push down the price, and the demand is holding it up. So obviously, it is a sign of strength. Now, let's look at other indications of shakeout or springs. Now, what is a shakeout? A shakeout is forced price reaction to push the weak hands into selling. Price pushed below the price support zone to induce panic selling. Price quickly springs back above the support zone. Let's look at an example to make it clear. Let me take out the same. Now this is an accumulation zone here. Now if you look at here, at this bar, the volume started increasing, and it is breaking out of the supply zone. So there, the panic comes in, and the weak hands, they know that it could, or they think it could go down further. It is breaking down the accumulation or congestion area. So a lot of selling is coming here. So the weak hands exit here which the strong hands get those stock at much cheaper price, and the next one you see it's all being absorbed, and you have a stopping volume. Of course, it's not exactly a stopping volume, but it shows that a lot of absorption has taken place here, and you're back into the trading range. So this is a forced move by the smart money to shake out the weak hands. So the shakeouts can happen in the accumulation areas or in other congestion areas in an uptrend. Of course, Tom Williams and VS, the trade guider, they have different terminology for this. They call it shakeout or terminal shakeout. A terminal shakeout happens in the accumulation area. It's actually supposed to be the last shakeout. There could be multiple shakeout. The last shakeout before the stocks are being marked up. That is the terminal shakeout. And some people call it spring. In fact, these are very good trading opportunities for us. Like now we know this is a shakeout. So obviously this is the right time to enter here. So you would have ridden through the uptrend here. You need not wait till it breaks there. Shakeout is a good sign that the smart money is ready to move up or play the game of markup. It is what I've shown you is in the accumulation area, but many places it happens in the uptrend also, and these provide a good opportunity for trading opportunity, a right entry point. These springs, some people call it the springs, like anything. This V's waves. Author, he called them springs, and he makes a very effective use of these springs. Now, since I'm talking about the accumulation area, let us look out how do we identify some of the accumulation areas. There are a few things we have to look out for the accumulation areas. First, of course, there should be indecision, right? Indecision is marked by low volume. So if you look at here, it's all basically low volumes, except during the shakeout, you have low volume. Second, the spread of the bars, high minus low, normally should remain low. Most of the times it remains low here. When small spreads, and generally the volume should shrink when you reach the support line or the demand zone, and the volume should increase when you reach towards the supply or the resistance zone. And of course, it should be trading in a range for weeks to months. Of course, here it is about 2 months of sideways range. So these are the things one should look out during the accumulation area. Another indication is the upthrust trap or the bull trap. Again, the first price, it is the opposite of the spring or the shakeout, but it happens on the upper side. So you have a congestion area and the stock just moves out the congestion area. So it looks, everybody's looking out, oh, it's a breakout, and then they start entering. But very soon you would find that it's back into the trading range. So the price is pushed above the resistance zone, enticing the herd to jump in. The price quickly swings back to below the zone. So normally found on the top of matured trends. Actually, these are not in the accumulation areas. Generally, you find them in the top of matured trends. These are useful indications. So of course, the spring offers a very good opportunity, easier to handle, but the upthrust trap is one should be careful. because it resembles a breakout, and then one has to be careful. Any breakout in an uptrend congestion areas are one should be very carefully handling that, because it could be a bull trap actually. So the general things to recognize the end of an uptrend. These are the indications which generally indicate an uptrend. It's an upthrust bar followed by a down bar. Then it can be a buying climax. That means a rapid, widespread up bar and ultra high volumes. And there could be a failed test, which is also an indication of end of an upthrust. And a narrow spread bar on high volume. This is what we talked about before, because it's a weakness. So these are the things which is indicating, because here the supply is overruling the demand. That is. So the sudden high volumes widespread down bar, widespread down bar is also an indication that these are the, like, it's not like all of them. One of them, can be multiple of them, but these are the signals which indicate the end of an uptrend, or the coming end. The uptrend will be coming soon indications. These we already talked about the accumulation areas. Okay, I think we will take a short break. Then I would talk about the volume waves, which I will just show you how effectively it can help us. So we'll take a, Rajendran, shall we take a short break here?
We can take a 10 minutes break and we can assemble by 12:20 p.m.
Okay, okay, right.
Thank you, sir.
Thank you.
So I think we can start with the session.
Okay.
Yeah.
Are you able to see my screen? Hello?
Yes, sir. We can go with that.
Yeah. Now, I'm just going to talk about another useful way, the volume waves, which is, of course, not basically into VSA, but this is part of the Wyckofian works, actually. But now these, fortunately or unfortunately, these are now more called as V's waves because of the book, the V's waves book. They're now more popular as the V's waves, but these actually Wyckoff did have such waves, the volume waves. If you look at his works or the training material, you can find these waves. Of course, they were more primitive, but we have more technology available to us, so we could plot these waves. So I'm just going to show you how effective this could be in telling us about the overall sentiment of the market or the mood of the stock. Actually, here I have the chart of Nifty with me. Now, I'm just going back into the historical chart to look at how helpful these could be. Right now, if you look at here, we are seeing a downtrend here, and at this point, like, you have the biggest. These are the waves accumulated when there's a down move. These are the volume accumulated volumes in the down move. And next you have an up move, so you have this bar, and here again it is. I'm just trying to explain you what are these waves actually. These are like the first volume of the first up bar, and this is an accumulated. Next is an accumulated volume of both the bars, and the third is the accumulated volume of the three bars, and this is the accumulation of the fourth bar. Here the sentiment changes and it's a down bar, so it is a just the down volume of this, or the selling volume. I call it the buying volume and the selling volumes. So what I've done additionally is that I've also plotted the price, the accumulated price in the up move, and the accumulated price in the down move and in the up move. So in the corresponding to the volume waves. Now let's look at how effective these are in helping us to understand the market. Here we have a downtrend, and this is the last part of the downtrend where you have the sentiment or the volume was very high. Whenever there is such a change in the big volume coming up, now if you look at the normal chart, you can see that the volumes have increased here, and you have a stopping volume as well here, right? So this is an indication when there is a sudden change, then there is an indication that you are nearing the bottom. And like exactly like that, the next wave you can see is a here small sideways movement. Then next you have an up wave which is quite good, of course, though not above the previous down wave. You have an up wave which is an increased up wave. That shows that sentiment is changing, and the next down wave is smaller than the up let's call it buy wave and sell wave. So the next sell wave is smaller than the previous buy wave, and here you have a pronounced increase in the buy wave, which shows the sentiment has changed from negative to positive, or the demand has started dominating the supply. And as you go, you can see the uptrend going with the sell waves are almost nil here. It's all dominated by up waves, right? And at this point, again, you see, suddenly you will see that the selling is dominating here, the supply is dominating here. And also in these waves, the congestion zones or the sideways movements are clearly indicated. Like if you see here, it is a period of the volume, like it keeps changing up, down, and the price also does not move much here. So this is like a stagnating or period where you can see it is, we are actually in a trading range rather than a trend here. Okay. Now once you have this sell wave, a dominant sell wave, you know that the sentiment is changing, but fortunately, like you have again, it is not a you have a buy wave which is not significant, but that means there is still life to the uptrend. So eventually we end up in a sideways movement here again. So this is clearly indicated. You have equal buy waves, equal sell waves, and here again it starts dominating in the sell waves. Okay. So this is a very, very useful indication for me. I found it very useful in analyzing the Nifty. The changing sentiments are very, very clearly brought forward. Now this is clearly a you can see here there's nothing dominating, like it's sell waves, buy waves, and the price does not make much headway. It's very clear here. So this shows that it's going in a sideways move. So this is a very useful indication, but often nobody, of course, very few people use such waves to analyze the market, but I found it really, really useful. Coming, let's and many people use this waves, the volume waves, but they hardly use it with the price wave as well. But I've been using it to quite successfully for this, both as a combination of buy waves and sell waves here. And here, here we start seeing the domination of the sell waves here, that is the supply is dominating. And here again, if you like previously I mentioned, a drastic increase in the sell wave, that means the volume. And as I told you, this indicates a drastic increase, indicates almost the end of the downtrend. Like previous example we saw. Here again, it's a big sell wave, and corresponding for the price also moved so much. And from here you can see it is like a sideways move here, because you have a good buy wave coming here. So it is moving sideways here. So this big change indicates the end of the downtrend. So this is a very, very useful indication. I've already, I mean, the buy waves, or what I call the demand and supply waves, I've already put it in my blog. If somebody is interested, can look at it. It can be quite useful. Of course, the price wave, will make it available if somebody is interested. Here, after this big wave, you can see here a buy wave, again followed by a buy wave, insignificant sell waves. So here again, we know that the downtrend, the congestion move is over, and we start moving up, everywhere dominating, and all sideways movements are clearly indicated here in terms of volume and price. So this is a very, very useful indication. I recommend that you people definitely look into it. So here again the sideways moves. That there's a sideways movements are clearly indicated here. So it's quite an useful chart, which is quite useful. Then another thing one can see is that, see, it is up wave. Now you have an up wave here and a corresponding price. The moment of the volume and the moment are quite collaborating or corroborating with each other. Here also you have the volume moment. Then you come here, you have a volume up wave, but at the same time the price is getting nowhere. Okay, that means and if you look at here, you have a big volume up wave, but look at the price. Price is not moved much. That means if the result for that particular effort is not there. So remember the second law, or the third law of Wyckoff, effort versus result. If there is an effort, there should be an equal result. If the result is not in line with the effort, that means there's something wrong, right? So here this clearly tells you that there's a large effort done, but the price is not moving much, which is obviously bad news. And what resulted was a sideways move here. So these are clear indications that things are not going right. Now you can expect some either it's not down wave immediately, it doesn't portend the down wave immediately, but the up wave is moving its strength and it's slowing down, it's fading out. So this is a very, very potent weapon for you. See, again, I'm repeating myself, up wave with huge volume, but the price wave is mediocre, not even as much as the previous up wave. So this shows the effort did not produce the required result. That is bad news. And what followed was a sideways movement. The sideways movement is very clearly mentioned here. Okay. Then of course we had the big UP results, and then you had the jump. And so here again, like of course I did not plot the last day's result, so but here it's showing that it's struggling. The price is not moving much here. The wave is up, but the price here is struggling. So these, if you look at this, these are like sentiment indicators for me. So these foretell what's coming in actually. So this is a very useful indication. The AFL is available in my blog. You can always use that. The price one, I'll make it available soon. So this can be used by you, all of you. So any questions here on this particular? No questions?
Let me pull out some of the questions. There are a couple of questions there.
Yeah.
The price change is open minus close or something else. That's what Mr. Agarwal asking.
For this particular chart?
Yes. Yes.
The price change is the like the previous close to the current close.
Mm-hmm. So previous close with the current close. Okay.
Yeah, that is why if you see here, the last bar, the price change is the huge bar here.
Okay.
It is, though the spread is very small. If you look at like open minus close minus open, it is should be like very small, right? But what I've taken here is the current close to the previous close. That is the overall price change. That's actually gives the real moment, right? Like how the price have been able to be marked up, like how much. We always have to compare with the previous close.
So there is one more question from Janta. His question is, should the ATR can be used along with VPA?
ATR, why not? Like, but unless I know how it is used, I cannot. But definitely, any other indicators can be used with VPA. VPA is not really like, it doesn't tell you exactly when to buy, when to close, but it gives a very good idea about the market, so you can make your decisions correctly. In fact, talking about other indicators, one of the things which I can't say like I don't like, but I find it little amusing is the overbought, oversold conditions. Everybody talks about overbought. You read the paper, the market is overbought, but you know that overbought condition can remain long. It is the basic construction of the RSI indicators like that. It can show overbought for a long time. It need not immediately know when it's overbought. It need not be like react immediately. It can remain overbought for a long time. So these kind of indications I really don't use nowadays. Basically, working on these VSA and then these wave charts, as well as the support and resistance. This is what I use basically for trading. So basic thing is the VSA, which gives me the overall idea of the market and the stocks.
So is there any basic difference between VPA and VSA, or both are same?
No, it is only the terminology. I think many people have their own concoction of the basic principles of Wyckoff actually. Many of them, like the MTI, if you take, they have their own this thing. They have some sentiment indicators and all that. They've added many things, and you have trade guider with their one indication. Tom Williams, of course, is based on Tom Williams, and you have other softwares which use other indicators to support the VSA. So it is loosely like based on everything is, but mine is more I think related to could be Tom Williams kind of work. And of course, the sentiment indicator, that wave indicator is basically William Wyckoff's work.
Okay. So
and
you
in fact,
inherit
if you
mostly
look
Tom,
at
mostly inherit Tom Williams
Pardon?
and Wyckoff works in your studies, right?
Yeah, Wyckoff.
Okay.
Yeah, but if you look at this upthrust bar, it is actually you will not find it in any of Wyckoff's work.
Okay.
It is more of Tom Williams stuff.
Okay.
Wyckoff, of course, talks of the concept of moving up and trapping the indicator, but he never calls it in a bar basis. It is like overall moment basis only. An upthrust move. It is not a bar. Wyckoff talks of it in terms of an upthrust move. When it's a move like completely trapping a lot of people on the top. It is a combination of bars, but not a bar as such. But this concept is quite, the upthrust bar is quite useful. We have to adapt whatever is useful. Tom Williams has done that. And yeah, tell me, any other?
How the interpretation can be made when there is continuous whipsaws are there? How will you interpret using VSA when you're seeing too many whipsaws are coming in?
Too many whipsaws are generally in the congestion areas happens, right?
Yes.
It is not it's not in an uptrend or this thing. Whipsaws happen in congestion areas. So ideally, one should try to find out whether it is an accumulation area or a distribution area. But it is very difficult to to decipher whether it is an accumulation or a distribution area actually.
So there is one more question from Mr. Agarwal. He's asking, last 2 days in Nifty, is it a no demand bar? Is it a no demand bar? This was his question from Mr. Agarwal.
Just a minute. Last 2 days. Yeah. Okay, that I cannot say for the last 2 days, but
I think your data is not.
I have data only up to the 15th. Right? My data is not up to date. Okay. But if you look at
maybe you can answer some other time.
Right. For 2 days, I'm not able to. Yeah. You can just drop in a mail. I will look at. But if you look at the 15th bar, it is a narrow bar, right?
Yes.
Closing at the lower, but the volume is very high. So always look at the volume to decide whether the volume is low. Okay, you can say it's a no demand. But here, if the data over the 15th, it does look like it is a tussle. A lot of selling and demand and supply. Like it's like coming equal almost, so that there's not much price movement. So they almost end up in a doji kind of. Indecision, or it's not here because the high volume it is not indecision, low volume is indecision, high volume is a tussle.
Okay. So there is one more question from Traders Line. His question is: we see in indicators divergence. So what he's saying is we see in indicators divergence like that. Can we use price wave with volume demand and supply when it comes to extreme levels? Can we use some sort of a divergence lookup in price wave?
Yeah, definitely. If, no, the divergence. Like now, I will just have a chart. Okay, I will just draw. This is the price wave, and you have right. There's a divergence, right?
Yes.
There's a divergence. Obviously, in other terms, I'm saying that it is not, the effort does not produce the result, but here clearly it's a divergence, and then the result is obvious, right? So you can definitely do a divergence. In fact, if you look at here itself, it's a divergence start happening because the upthrusts start weakening. That itself is like, this is an upthrust. Like, I will just draw the upthrust, just a minute. Here it is an upthrust, here, or up move. What Wyckoff would call it as upthrust. These are weakening. If you can see, these are weakening. Like, so that itself is an indication that it is losing momentum. The up move is losing momentum. So definitely, yes, Agarwal, if you can do the divergence here.
Okay. And there are other questions. Can you explain how the demand and supply histogram is drawn? Calculation for those bars available in your blog. So this is a question from Mr. Yogananda.
Okay. Okay. These are like you have a reversal. Like if you look at the parameters, it's a reversal bars. Okay. Any reversal is based on 5 bars actually, right? If there is a price is going up and it comes down by 4 bars, 4 points, then it is not a reversal. But if it comes down by 5, it is a reversal. It's like that. This is a reversal bar. So we call it reversal bars. So as long as it's the up move is it's a cumulative, like you have the volume here, then it is an up bar here. So you cumulatively add the volume, go on cumulatively adding till the reversal happens. But here the change is more than 5 points, so here the reversal happens. So one has to keep adjusting the reversal bars depending on the volatility of the stock actually.
Okay, so many are curious about whether the demand and supply and price wave are available in your blog.
Okay, demand and supply is definitely available. One thing to note here is like it is that AFL is based on zigzag. Okay, so most people immediately say, "Oh, zigzag, don't use it. It looks forward." No, because here we are using EOD data, right? And I don't think it's going to make a difference. In my frank opinion, it's not going to make a difference. I'm trying to develop one not using the zigzag line, but right now what is available is using the zigzag formula. So it is available there. Price change wave is not available. I will upload it soon, and maybe I can, once it is available, I send it to you. You can send it to the participants if they require it.
Yes, sir.
Okay, I will make it available soon. But the demand and supply, maybe it is not called it as, maybe it's called price wave. It's volume wave. It is not called demand and supply. So I keep changing the terminology, keep experimenting. So it is definitely the price wave. I make it available very soon.
Okay. Oh. Another couple of questions from
tell me.
Ashok is curious about which software have you used? I think it's Amy Broker. Yeah.
Yeah, I started with Metastock, but Metastock has got limitations on many things. So I've switched over to AmiBroker. I've also worked on Ninja Trader. In fact, my buying and selling pressure indicator, I personally translated Ninja Trader, but it's quite challenging as a code for writing the code. It's quite challenging for me, so I've switched back to
then how are you
broker because it's much more.
How are you able to observe the trade guider? Trade guider is an e-signal, right?
Pardon?
Trade guider is from e-signal, right? So it's an e-signal. It's one of the e-signal add-on.
Yeah.
So they have They have a Ninja Trader add-on as well, Trade Guider.
I have no clue actually, because frankly, now initially I used to look at Trade Guider a lot, but now I don't even look at them. Like I'm happy with my own stuff, and then I don't even look at them. Like just yeah, tell me.
No, I mean, there is one more question from Mr. Ritesh. His question is,
Yeah.
it's difficult to overcome from bull trap or bear trap shakeout. What is your advice?
No, it's a bear trap, of course. Once you short, then you are in trapped, right? The only thing is to work with very strict stop losses. I mean, very tight stop losses. Otherwise, like you may get trapped. There's no other thing. You don't have a buffer for your. Normally, I used to have a buffer for all my stop losses. Giving some buffer for so they dip the price too much, then I don't want to be thrown out. So I give a buffer, quite a what do you say, easy buffer. But here you have to work with very tight and strict stop losses. There's no other go.
Okay.
But always look at volumes. If the volume is good, the chances are that the breakout is genuine. It is not a trap. Look at volumes, and also look at some patterns. Like for example, I'll just give me a minute. I will just take out this chart. Okay, let's look at some of the things you can look at is like if it's a trading range, So now this is actually a trap, right? If you look at here, it is a trap. But here, of course, you don't lose much because it is immediately you were back. But if you hold on, you can escape. But that is not the good thing to hold on. But if you look at here, initially the range, it is like from here to here in the top. It is always trading from the resistance line to the support line. But as you go here, it starts more the strength. You can see the strength is always trading above region. So in such cases, most of the times your breakout is like more genuine. And you look at here, this is not you should not be trading this because the volume is quite low. But if you look at here, this is an effort to move bar with high volume. Definitely you can get in here. There's no chance of you being trapped here. So look at volume. Volume is very important. I know there are so many people trading without volumes. I really cannot accept. I mean, mentally I cannot accept. Personally, I cannot accept not looking at the volume actually. So look at volume. That is very, very important.
So there is another question. What is the interpretation of volume waves in Nifty currently? Is it bullish or bearish? This question is from Jackie Waswani.
Okay, volume is.
Volume waves in Nifty.
Let me. Yeah. Unfortunately, my data is not up to date. So because we have been moving in this thing, then we had a. What was the last 2 days prices? Nifty. Rajendran, can you tell me the last 2 days?
The last 2 days there was a gap up in Nifty. On Thursday, there was a gap up. And on
Okay.
Friday, it just fall with again there was one more gap up, and then but finally it fallen down, and but still it haven't broken the previous day's low.
Okay. Okay.
So Thursday was a gap up, and Friday
So
was again a gap up, but it ends within a range.
so it's going to be because I don't have the data, but if you look at the gap up is how many points? Any idea?
The gap up on last
Thursday.
Thursday. Thursday is
Thursday.
you want the size of the gap?
Yeah, yeah. Or yeah, size of the gap. So I can just guesstimate only.
Just give me a second. I'll give it. So the size of the gap is probably around say, sorry, very, very minimal, probably 20 plus points.
Okay, okay. That means
I mean, compared to the previous day's low.
lot of effort.
I'm
Yeah.
sorry.
So
Compared to the previous day's close, it was an almost an 50 points gap. So 45 points gap compared to the previous day's close.
okay. And the volume was good or bad? High?
Volume in futures is pretty low. Pretty low. I mean, average. You can say not low. It's average volume. Typical average volume.
Okay. Typical average
Last
volume.
2 days.
Okay.
Last 2 days are
That
typical.
means just a minute. Okay, only up to 15. Sorry. That that means and there's a lot of effort, but the movement is not much, right? So it is like not very good. That's what I mean. Just now I'm guessing that when I update the chart, maybe I can post it somewhere so that you can look at it. Tomorrow I will definitely do that. But from what I just guess is that a lot of effort is being made, but the results are not as required. So we could have a pullback, a little pullback before we proceed further. That's what right now I can say without looking at the details. Okay, maybe I'm wrong, but this is what I can say now. Any other question? Any other question here? Hello.
Question from Jackie. He wants to know
Yeah.
what is your interpretation on Reliance or VADL?
Reliance. The Reliance, of course, we had big moves. And
So how do you see that the wide range
now,
is coming in on
pardon?
last month in Reliance there was a big breakout, right? So how do you seeing this? Is that a start of the markup phase?
Yeah, it is. It is definitely a startup of the. Of course, it has been in a sideways range for quite a long, I think, almost like years kind of thing.
Yes.
It is moving between 1100 and 900, and definitely now this is going to a new territory. That is clearly seen that right now what is happening is that this is the what I look at as the where the last price was rejected. Okay. So you have the price rejection. You must have seen my charts. I always put as price rejection area. I don't go by the close or this thing. What was the last price which was rejected here? This 1305 was the last project rejected. So it has to effectively cross and high volume this price. Then it will move to the next level. Right now it is going to be trending like moving sideways till that is crossed effectively. 1305 is the last price. So of course you had the high here, like the pseudo upthrust bar here at on the 7th. But I do not know. I don't have the last 2 days data, so I don't know whether we crossed 1305.
I think
Did we cross 1305?
in spot, the price is trading around 13,000, around that, exactly around 13,000. 1,300.
Okay, 1300.
Yeah.
So it has to cross the 1305 effectively in higher volume. You're seeing that the volume is tapered off here, right?
Yes.
So we need to see higher volume coming, and 1305 is could be the last price rejection level actually, because it was never able to sustain anything about that. That is the last price rejection. Similarly, I have just to share with you, I don't use like my resistance levels are not the normal ones. I use the price rejection level. And if you, I don't know whether if you any of you followed my the Twitter or my Facebook, at Sun Pharma, I had clearly indicated 675 before anybody could saying that. I said 675 was a very crucial level.
Okay.
Okay, but nobody else talked about. But and for me, this was the price rejection level. The price could never be sustained before, and it did give a lot of struggle around this region. Right. Okay, now right now, if you ask me which is the price rejection level, this is the price rejection level.
Okay.
Are we able to sustain? This came here, but it is not able to sustain that price also. My price rejection level is 693 now. Similarly, I have also looked at price support level. Where was the last support given? Beyond which support came in. So I look at price, for example, for me here, this is the support level, not here. Most people would put it here, but for me, this is the support level.
Okay.
So I have a price rejection level and price support level. This is what I follow, and I find it quite effective actually.
Okay. So there is one more question.
Yeah.
How about a future traders? Like when it comes to trading in futures, one have to still look into cash markets, or they can prefer using future charts itself.
I think they should be able to use future charts as well, but frankly, I don't do futures because I cannot concentrate on the market full time, so I don't do futures. So I'm not the authority to say, but technically speaking, it should be possible using the future charts. But looking at spot will definitely help them also.
Okay. Okay.
In futures as well.
Okay. So and one more stock is pending. I mean, Jackie is asking about Vedanta.
Yeah. Vedanta. It is VD something, right?
Yeah, VADM.
This is the one, right?
Yeah.
Vedanta.
So currently closed around 265.
265.
Yeah.
265 is, again, for me, it is the price rejection level, actually. It is closing around that, right? Anyway, let me look at the wave chart. So it's going to be it's going sideways only. Okay. So we need to see it moving above 265 effectively, and first, otherwise it is moving sideways now. And I don't see any negative. Most likely it's going to move above this, because when the volume pattern is also, it's dropping down here and then down, and so it's positive, of course, but it has to, the prices rejection level is 265, it has to move or effectively beyond this.
Okay. So there is one more question on Adani and Enterprise. So yesterday it closed at highest weekly levels with 1.5 times volume. So again, I mean, Janta, it doesn't has the recent last 2 days of data. I think we cannot look on.
Okay.
Yeah.
Yeah, that's the problem. Sorry.
So I think most of the questions has been covered.
Okay. Just I mean, few minutes before we, I mean, I think it's time to close also, right? We have the next webinar coming in.
Yes.
So just one few minutes before I close, there's one of the, the one indicator which can help you is the effort versus result indicator, which I've made, and this is quite useful in the sense, like for example, if you look at this chart here, the effort and the results are equal, so it is a very valid move. So obviously you see it moving down, and so these could be really helpful for you, because maybe in another webinar we can go into details of this, since the time is not there, but this is definitely useful looking into this as well. And one request is, tell me.
What we'll infer from the effort and result in index?
Actually, if the result is not equal to the effort, that means things are going wrong. So you can expect the things to change. Like it's not like a dramatic reversal kind of thing, but if it is a bullish, it could stop being bullish and move into a sideways move. But that shows weakness actually. Anything which is the result is not equal to the effort, it is weakness.
Okay.
Okay. One request I have is, please give me feedback on how the webinar went, because this is my first time I'm giving a live webinar like this.
Sure.
I don't know whether it was useful. I need feedback.
You can log into the Slack and you can see the feedbacks pouring in. I request everyone to please kindly post your feedbacks on the market profile section. So that's a section which we are using for all volume studies and price action based studies or sentimental studies. So I request you people to post your feedbacks on the market profile section. So I guess, sir, you have access.
And kindly.
You have access to Slack, right?
Kindly. So, yes. Kindly provide your feedback on how to improve also, so that the next time we do it, it will be much better.
Yeah.
So it has been a learning experience for me. Thank you for all for bearing with me of all the shortcomings. Being the first webinar, do excuse me for this, and hope it has been useful to you all. Thank you very much.
And you said that you are a poor coder. I was just going through your codings, and you have done an amazing work. I mean, a poor coder cannot do that way. Yeah.
But somehow I'm not successful in making DLL files so far.
Okay. I mean, I don't think so. It is not a bigger deal. I mean, we can talk over offline. I mean, I can help you out in converting your DLL. I mean,
Okay.
Not a big deal. Yeah.
Good, good. Thank you. Thank you very much.
Sure, sir. Yeah. Thank you. Thank you, everyone.
Okay. Thank you. Thank you, everybody. Bye.
Sure. Thank you.